What's going on, guys? So I want to break down to you guys, give you guys a walkthrough of TradingView, but also explain time frame analysis. So up here, when you get to tradingview.com, which is the main site to, kind of mark your charts, understand you won't be allowed to trade on TradingView unless you use, Oanda or forex.com, as a broker. I think it should be here, forex.com, Oanda, AMP, and they got some things right here that you can obviously trade. But if you use any other broker, you won't be able to trade on here. But at the end of the day, I want to break down because you won't see this smooth of a chart on MetaTrader 4. So up here is, you see this is 1M, 5M, 15M, 30M, 1 hour, 2 hours. This is basically, the time frame that you're currently on right now when it comes to the market. So what that means is these are called candlesticks, which I get into the next section called Japanese candlesticks. Each one represents whatever time frame you're on. So all of this represents the last few weeks in the market. This one thing represents, the current week we're on. This one represents the last week. As you see all the way down here, excuse me. As you see all the way down here, it says, August 3rd, August 10th, previous week, July 27th, July 20th, July 13th. This is how much the market moved with this particular pair, gold, within that week. Same with this week. If I want to go down to a daily, 1, 2, 3, 4, 5. Each represent one day, but these five last candlesticks, because obviously there's 5 trading days, 2 of the days are closed. These 5 represent 1 week. So 1, 2, 3, 4, 5. So you can kind of see why this weekly candle looks like this with this big stick, which is called the wick, which I get into the Japanese candlestick section, which is why it looks like that, because these last 5 days made up 1 week. You can go all the way down to the 1 hour, and obviously the last 24 1 hour candlesticks represent, one daily, and so on and so forth. So these are just time frames, and I get into how to use them in the technical analysis section. Now, in terms of just trading view in general, so this is, up here, or you can just type it in general. If you want to look for a particular pair, you can just type, Euro, USD. You can click it. It goes right to that chart. Any pair you want, you just type it in, GBP, USD. It comes right up. You can right click it and click remove drawings at any point in time. It deletes it all. Indicators, you want to add an indicators here. Your templates that you save, like, so if you save an indicator, like I have a moving average save, templates, save indicator template. Over here is where you have your tools. So your trend line is over here. If you want to draw a trend line, it's right there. Anything in general, horizontal line for, like, support and resistance, that's all there. The ray, which is like a halfway mark, same thing, all there. Everything is all here. Over here, Fibonacci retracement. The brush tool, if you want to draw it, out yourself, like this is the undo. Everything is here at your disposal. If you want to, lock all drawing tools, you want to draw a bunch of, support and resistance. So boom, 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 draw as many as you want. Obviously, I get into it later, but if you stay on drawing mode, it obviously does as many as you want. Remove drawing. Little things right here are here, little call out tools, whatever you guys want. You can moderate your chart however you want. These is like obviously the currency pairs, the quotes, obviously GBP USD equals 1.30787 at the time. You can go over here to the right hand side and have your watch list. So the only pairs you want to focus on trading. So if I want to focus on, Euro USD, I can click it and it'll come right here. So I can just click anytime, click it anytime, click it anytime. It's all there. This you don't really got to worry about too much. This is, I would still focus on it on a fundamental side when we get to that on, series 3. But this just allows you, to click it, and it gives you like an article on what the market is, talking about in terms of, Euro USD, the pair is trading. If you go to a different pair, you may have different headlines, headlines for XAU USD, aka gold. This is where you'll put your alerts if you want to set an alert, in the market, and you're not really on your phone, but you want it to alert you when the market gets to your certain price. That's where it'll be at, and so on and so forth. There's not much to learn about, MetaTrader 4, not MetaTrader, TradingView in general. It's very simple, very straightforward. I just want to walk you guys through the process. But TradingView.com is where you'll be analyzing most of your trades and most of your materials. So I hope this video helped you guys out a lot, and I will see you guys in the next video. We are into a deeper section. We are finally about to understand and learn technical analysis. And the first thing we're going to understand is market direction and trend lines. So
in order, like anybody can scroll back in time and see this is dropping down, or this is going up, or this is going up. So how do you figure it out? There's a thing called a trend, and we have this thing over here, this tool called Trendlines. And what trend lines are is they help us identify a trend, so we're always trading on the right side. So in order to identify a trend, let me go over here. You need to figure out what price is doing. So an uptrend consists of something called higher highs and higher lows. So for example, if you see price doing this, going up, making a high, coming down, making a low, because this low is higher than this low, so it's a higher low. Coming up, making a, excuse me for this, there we go. Coming up, making a higher high, coming down, making a higher low, higher high, higher low, higher high, higher low. And obviously if you have a trend line, you can just drag this on the bottom and it bounces off of it every single time. And that's what trend lines are for, to help us kind of gauge when it's going to bounce. Usually when it bounces off, you buy, 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 and now you're in 3 different trades, all in profit, if that makes sense. Uptrends consist of higher highs and higher lows. And it's the same for, let me delete this, same for a downtrend as well. Downtrend consists of lower highs and lower lows. Low, lower high, because this high is lower than that high. Low, high, low, high, low, high. And obviously our trend line goes across it. So now we can see that it bounces off every single time and we're always on the right side of the trend. There's also this thing called consolidation. What that means is the market is not going anywhere. It's moving sideways. It's going up, down, up, down, up, down, up, down, up. It's not doing anything. What we usually do with consolidation is we place a box around it and we just watch it bounce off, excuse me for that. And we just watch it bounce off both sides of the box. And all we're doing is waiting for it to, break out in one clear direction so we can sell it or buy it in that way. So for example, you can see right here where a trend line would be. You just connect point A and point B and drag it all the way across. And you keep buying it. We are not looking for sales. When it comes back down, this is just a retracement. And I have a video in here that talks about the difference with a retracement and a reversal. Retracements happen. Reversals mean a whole change in trend. A retracement just means it's just coming down, just to come down for a quick second, because what you should know is price will never go straight up. Price will never go straight up or never go straight down. It's gonna make higher highs and higher lows, or lower highs and lower lows. So we get up here, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. And it's constantly doing it and it's bouncing off of it until what happens? It breaks through it. Once it breaks through it, then we know the trend is over and now it's heading down, and we can obviously delete this trend line. That helps us with market direction. Same with over here, uptrend. We see how it bounced off every single point, buying, buying. And then when it finally breaks this trend line, we know what happens. It just crashes down, crashes down. So go in here, look at a chart and see if you can spot, some trend lines, some areas of consolidation, downtrend right here. Once it breaks through here, now we can look at and find our entry on getting in right here and then buy it all the way back up. So I hope this video helped you guys out a lot. A lot of these technical analysis videos are going to be short and straight to the point, because I feel like they're very easily understood, because it's not, it's not much to really understand, just understanding market direction, higher highs, higher lows, lower highs, lower lows. And that helps you figure out where the trend is going to be. To understand about all of these things over here, they are called Japanese candlesticks. And I'll tell you how to read them in a second. So if we're going back over here, Japanese candlesticks help us understand the open, the close, the high, and the low within that time frame. I don't know why I have a 3-minute chart here, but I'm not okay with it. So we're gonna, scale back over. So you see how, these have these bodies and these lines. All it means is this. So let's say, for instance, let's say if price is going up, right? It'll open right here, start right here, right? And then what price will do is price will go up, up, up. Perfect. So you guys can see it, right? So it's going up. So you know you're in profit. Whenever price starts to pull back, it will leave a thing that we call a wick, which is basically a trail behind that shows how high it went during that, specific time frame. And if price goes all the way down and down and down and down, the wick obviously follows. And since it's going down and you're actually losing money now, if you were, well, not even losing money. Let's just talk about what it does in that session. If it's going down, obviously it's more of a red candle now. We're bringing it down. And let's say it comes back up. Boom, let's say it stops right here. That candlestick will look just like this. It'll tell you. Now, if a candle is red, that means it opened up here. This was the highest point it went to. This is the lowest point it went to. And this is where price closed at. If a candlestick ends in blue, that just means price opened here. This is the highest point it went to. This is the lowest point it went to. And it closed here. So it tells a whole story in between it. So you can see clear as day right here. Price opened here. It went all the way this low. And then it came up and closed here. The next, since we're on a daily time frame, the next day, price opened here, got this low, then went all the way up here and closed right here. Next day, opened right here, went this low, went this high, closed right here. So the Japanese candlesticks tell us everything we need to know. So when you're trading, look at these Japanese candlesticks, and you'll see in the next section how, these Japanese candlesticks have a pattern. Like you'll see, if you see 3 green candles in a row, that's a pattern. Or if you see 1 red and then like a small candle and then like a big green or blue, that's a pattern. So go to the next section to kind of see the patterns, because this is not a bunch of random candlesticks. I swear it's not. Like this right here is a pattern. It's called the shooting star. We'll get into in the next basically the chapter in the series, where if you see this, price is about to reverse and go down. So boom, drop all the way back down. This is called a doji. When you see a doji, it's indecisive. Like the market is being indecisive right now, doesn't know what it wants to do. This is called the tweezer top. When you see a tweezer top, price is about to drop all the way back down. So right now, don't get caught up on, the chaos and the clutter. No, it tells a whole story. It's a lot easier to understand. They all tell a story, but they all are patterns, and you'll see the patterns in the next section. So we are going to talk about support and resistance. This is one of the most important things you need to know on how to accurately, draw on your chart. So one of the major tools of technical analysis is a thing called support and resistance. What it is basically resistance is a thing that is, a term used for the ceiling. This is a terrible box. Let me get it calmed down. Perfect. So what this is this is the resistance. It's basically saying every time price gets up here, it is going to go back down. And if it breaks through it, then obviously it becomes the new support. I'll get to that in a second. The bottom is called support, which is also known as the floor, meaning whenever price gets down here, it is going to bounce off. It bounces off the floor. And you can have multiple support and resistances on your chart. For example, you see how price, bounced off of here, came up, bounced off this support, came up, bounced off that resistance, came down, bounced off support, broke through resistance. And whenever price breaks through resistance, it is now support. This resistance is now support because price is trading above it. Then same thing again, comes down, it breaks support, and now this is now resistance. So anytime your box is above the price, it is considered resistance. Anytime price is below, no, I said that wrong. Anytime price is above the box, the box is support because price is above it. Anytime price is below the box and the box is above, it is considered resistance, the box. And how to find support and resistance on your chart is what you want to do is just kind of back up a little bit and see where price stopped at several times in the past. So I can see clear as day where price stopped here with this wick, it stopped over here, it stopped right here, it stopped right here, and it stopped right here as well. So I'm going to place that as one of my first areas. And it's now support. Because over here, it was labeled resistance and it came back down. Broke through resistance, came back down. Now support, broke through support again. But now it held firm. Now it's holding firm. And now this is our one area. And now we got to find a resistance. So now, like I said, clear as that, I can see price stopped here a lot. So I probably would draw here as an area of resistance. Remind you, just like I said with sentiment analysis, everybody looks at it same. Everybody has support and resistance. Like you have to trade with support and resistance, obviously, but everybody places it differently. You know what I mean? Like when you get into series 2 and series 3, you'll see my intraday strategies and my swing trading strategies where I place it at a certain level for every single pair, and I get deeper and deeper into it. Right now, I'm just going to teach you guys like the actual definitions. Support and resistance help you understand what price is going to do. So like I said, with the price is coming down, I see it going here, and then just like I said in the market patterns, if I see this doji and this bullish engulfing, but these three make a morning star, what am I going to do? I'm going to buy it. So I'm buying it, and now I'm predicting that the market is going to go up now. Why? Because it bounced off my support. So if price is way up here, and I see it getting closer to my support, I'm predicting my support is going to hold firm, and I can buy it the minute it bounces off of here and go back up. And now it's the same with over here. If you don't want to get in too early, you want to make sure it bounces, because price can't just go right through it. Just like you see several times over here, it went right through it. It didn't bounce off of here, you know what I mean? So right here, it bounced several times before going back up, but you got to make sure you want to see a bounce before you actually want to get in. So I hope this video helps you guys out, just understanding support and resistance as a whole in general. Like I said, you can even go back in time and place more support and resistance just so you can have it on. Like I said, I believe in having like a clean cut chart, so I don't have too much on it. I can even make this lighter for a second. You can kind of see clear as day. Have an area right here for support. Then we got an area right here for resistance. And you don't even need a box if you don't want to. You can easily have like a little line, like a horizontal line, to have it go all the way across. And you can label it as, major resistance area 1.84. So you know what I mean, already where it's at right now. And same with over here. You can draw a line and have the same, effect over there. And now you have this area where price is just trading in between. And now you're waiting for it to break this resistance or the support. And then if it goes higher, then we got to find our next area of resistance, which can be obviously here and here as well. Now, like I said, I don't trade my support and resistance placing it randomly or just placing it wherever price stopped at. No, like I have an actual strategy, but that's in series 2 where I break down my full intraday strategy. I work on entries, I work on exit strategies, but this, course and this actual, series 1, this is literally just for newcomers, like people who have never, ever, ever heard of the market right now. So right now, I don't want to overwhelm them with strategy talk. I just want to, get them to understand the definitions. And then when they get to series 2, then clearly they want to, dive deeper into this. And then it's time to ramp it up and start talking about, actual strategies and actual, key level placements and stuff. So I hope this video, was very informative, and I will see you guys in the next one. So let's talk about Fibonacci. So a key thing about Fibonacci in general is just to understand, what it really is and how it can help you, technically. So what it is basically saying, after price makes a major move in a certain direction, like a trend, like going up. What a Fibonacci retracement, this tool over here, what it basically is saying is that right here, is that the market has to retrace at some point, which it does. It has to find balance, retrace. The market won't ever just go straight up. It'll go up, retrace, and then go up again some more. So what the Fibonacci retracement does, I'm not going to get into the definition. If you want to learn the definition, just go on Google somewhere, because the definition is, very, very long and in detailed, but it's not really important. Like, you don't need to know the definition. It's just to know it, You know what I mean? Like, what's important is if you know how to use Fibonacci in your trading. What it basically is, it's a series of numbers that, if you add, 0 plus 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, 3 plus 5 is 8, 5 plus 8 is 13, and go on and so forth. You add the last two numbers you use, and then you divide, the closest two, and then you divide one and like skip one, and then the next one. It comes to be a series of percentages, and you can use Fibonacci extension, retracement with a lot of things. Now, like I said, that is a lot of, definition for no reason that you don't need to know. What you need to know is how to use it. So, for example, use it to allow you to understand what a retracement is. And usually once the market gets to these retracement levels, what it will do is it'll bounce off these levels and then go into your take profit area. So what you want to do is, if price is in an uptrend, you want to go from, bottom to the top, right? If it's in an uptrend. So from right here, you see how price went all the way straight up and then it came down. You want to go from the bottom here to the top, drag it over, and you see zeros at the top, 100s at the bottom. So these four areas are your Fibonacci retracement areas: 38.2, 50, 61.8, 78.6, and 100. Let me just delete everything here just so you guys can see it clear as day. So these are your Fibonacci retracement levels, meaning price should bounce off of one of these levels and head all the way to our extension level, which I'll explain in a second, right? So these are our retracement levels. So price just broke through 38.2 and 50 and 61.8, and now it's looking like, well, it didn't break through 61.8 yet. It's still bouncing off of it, but it's Friday, so the market closed here. So we can see how it'll play out. But whenever the market usually bounces off one of these areas, it won't bounce ahead straight up. It'll bounce, give us a doji, and then give us like, some kind of, candlestick formation, whether it's a morning star or something that tells us it's going to head back up. And then where it will head to is past zero to something called our extension levels. Our extension levels is a 27 extension and a 61.8 extension. These percentages are calculated off of those series of numbers that Leonardo, Fibonacci, created, which is not really important. It's more so understanding just how to use it, which is what we're doing right now. So basically, you won't see Fibonacci everywhere. It's only after a trend. Once you see a trend and you see the market coming back and retracing, then you use your Fibonacci tool to help you figure out. And if we go back in time, you can see how it all plays into effect with all of our, our features and confluences. So we have our 78.6, which lines up with our trend line, our minor, support, and then we have our take profit, which is up here, which lines up with our 27 extension. So all the confluences are there telling us that price is going to bounce off of here and then head all the way back to the 27 extension. If it goes, even further, we're looking at, new highs of 61.8, which is 185, which it just was there, previously a few weeks ago in June. But that is just simply explain how to use a Fibonacci extension. That's just simply in an uptrend formation. You just go from the bottom to the top. And if you see a downtrend formation, you just place it from the top to the bottom. But like I said, you won't see Fibonacci everywhere because it's not really needed everywhere. Over here, it's a clear as day, down the bottom to the top right here. It clearly bounced up to 61.8. What did it do? It gave you a bunch of dojis like I said it would. And then now what is it doing? It's looking to head up, maybe a little retracement, then up some more, break through zero and head to our 27 extension level. Now, understand, it won't always do that. It doesn't have to. You see right here how price consolidated right here. Price can consolidate over here as well. And then disregard this whole 27 extension. Usually if you see a double top, which we talked about in series 1, earlier in the market pattern section, up, down, it won't make 3 or 4 or 5 and then go to 27 extension. Once it does that, you're makes that double M or double bottom, depending on if it's an uptrend or downtrend. You might as well just delete the Fibonacci extension. It's pretty much, done at that point. But still have it there until it gives you confirmation that, the Fibonacci is no longer valid. But if it is valid, no, it doesn't have to go to the 27 extension all the time. But I would say 80% of the time, 90% of the time, using the 27, 61.8 percentage as your take profit is always a good thing, because that is the most appropriate level for your take profit, and especially if it lines up with other levels that prices previously had trouble breaking in the past. Like the 61.8 level matches up perfectly with right here, this level right here. You see clear as day how it all kind of lines up, so it makes sense. Even over here, we have a line right here, which when price stopped here, it came back down, and then obviously pushed back up right here. So The more confluences, the better. But understand, like I said, you won't find Fibonacci everywhere. So don't try to force it or look for it too much. Just like over here, remember what I told you last time? If this wasn't in the picture, if I bar replayed this and went over here, this would have been a Fibonacci. But it's going down, so you start at the top, right the wick, all the way to the bottom. Zeros on the bottom, 100s on the top. Now, 50 extension, we would think, all right, going to 27 extension. But remember what I just told you guys just now. If I fast forward this all the way faster, look at it. It made that double bottom. Stopped right here, came up, came back down, double bottom. Fibonacci is no longer valid. You might as well delete it now, and price is off to the races, heading all the way back up. So price leaves clues all the time. It lets you know exactly what it wants to do. It's just up to you to distinguish it and figure it out. So I hope this video helped you guys out a lot. Remember, you won't use Fibonacci all the time, but when you see price going clearly in one trend and wants to pull back a little bit, understand that it's just a retracement, and the Fibonacci will help you distinguish if it's a retracement or reversal. Reversal if it breaks that 78.8, 78.6 extension and it's not turning around, or a reversal if it's like it creates a double bottom or double top, and the price won't do that on Fibonacci and still go to the extension levels. The Fibonacci is over at that point. I need you guys to understand the difference between a retracement and a reversal, because what I don't want is for you guys to see a slight retracement and then get out thinking price is going to reverse, and then you just missed out on a lot of profit. It's cool to always, I would never complain about you guys taking your money, but I want you guys to be smart. Take your money when you see fit, or when it's about to hit your take profit or close. Don't get scared and not have patience and see price play out the way you expected it to, because chances are it will. So in scenarios like this, you get in right here, right? And price goes up and comes down. People may think it's a reversal because it's coming down, but all it is just a retracement. It's a deep retracement. Well, all it is a retracement. That's why I use the Fibonacci retracement tool to distinguish. If price ever gets below 78.6, then you know it's a reversal. If it still bounces off 61.8 and 78.6, you're good. It's just a retracement. Like boom, retraces off, goes up, goes up, goes up, boom. Now over here, when you see price get up here to the 70 level, come down, come up, and this is the next high. This high does not take out this high. It creates a lower high. That immediately invalidates some of these trades in the direction, and now we're looking at sells because it created a lower swing high. So now we're looking at this right now. We're looking at Aussie right like this. We're creating our Fibonacci from here to here, and we're seeing price obviously go to the 68 level flat out, bounce off 38.2. Now we're seeing it come down here slowly but surely. So the way to distinguish a retracement versus a reversal, like I said, a retracement will just come, it'll still bounce off the Fibonacci. It's not the real move. Like I said, you can tell what the real move is. You gotta look at the weekly, see what price is doing. If price is heading down, but you're on a 1 hour, well, if price is heading down on a weekly, on a 1 hour, you see price heading up, it's a retracement, because that 1 hour is not gonna invalidate the weekly. It's just coming back up just to retrace. And then if I can get the brush tool, if on a 1 hour you saw this, it's nothing. It's gonna just boom, just do that. Now, if you saw it on a deeper time frame, like a 4 hour daily, like you see something like, if it's coming down, right? If it's coming down like you see it is, and then for some weird reason, it creates a doji, like it does this. You see price do this, right? A clear doji, red or green, doesn't matter, right? We do red or green, right? And we see a clear doji like that. We come down, we see a doji that's this big. On a daily time frame, it's starting to tell us, okay, there's not enough sell. Like we're seeing right now, all these dojis, it's telling us we're not seeing enough sellers as we thought we would. Price, the buyers are trying to come back in, the bears, and then the bulls are pushing up and pushing the price. So now it's doji and doji, and then it's going to continue to make this pattern. Continue to do this, continue to do that, continue to do that, until it creates what? Consolidation. Boom. Now we can turn this into our great daily area. Boom. And now look what happens. Price will finally, one of them will win. The bears will win maybe and continue down like the overall trend suggested. Or maybe it'll continue up. But you know that based on the higher time frames. Remember that. Like the higher time frames will tell you everything that you need to know. They'll tell you, okay, this is just a retracement, just a reversal. Like, because chances are you're looking at a lower time frame for entries to get in a trade, but you look at the daily and the weekly to see, okay, price has been heading down for a few days or a few weeks. Like, I think price is going to continue to head down. Then you go to a freaking 5-minute chart and you see price heading up. This is just nothing but a retracement. Don't even think about getting in and trying to buy it. So that's basically all you got to know in terms of retracement versus reversals. Whenever you see price coming back up like this, all you got to do is simply place your Fibonacci tool somewhere. Let's go to Euro USD. All you got to do, like even for Euro USD, like just place your Fibonacci tool. Even here, like price comes back up. This is a perfect example, actually, by the way. So let me close this actually. So price started here. Let's say you got it right here, right? Boom. And this can, go into, it comes up, comes down a little bit, retraces, comes up again, does not go past this high. 100% is going to go down to that 110 level. It wasn't going to come down, reverse all the way down. No, it's going to come down to the next key level. Then we can go from there. M is a formation that is it's a reversal formation. So when it comes up right here, what I would have done is when it come right here, come down, come up again. Once I saw this this high did not take out that high, and I saw this bearish engulfing, I probably would have gotten out. No, I would have gotten out right here, right here. This is the last swing low it made, last lower high it made. Once it breaks through there, then it's time to get out. It's like, all right, cool, I'm gonna get out because it's reversing right now. Even though in the grand scheme of things, it was a big retracement, you don't gotta wait for big ass retracements like that. You see an M, you see a reversal pattern, it broke the last swing high and it broke the structure, get out, boom. But you know it's gonna bounce off 110. This is a major key area. This is a monthly key area. So it's not just gonna bulldoze through. Right here, now you wait to see what happens. And look what the market makers do. That's why you got to put your stop loss at a key place and a little bit below here because it comes up, comes down, boom. It would took people out. If you had your stop loss below here, price would have hit it and it would have took you out. Let me go back to blue. You feel me? Price would have hit it and took you out. So that's why you always got to keep it a few pips away from the last low or the last high. Now, just like it made an M over here, a M is a reversal, it's a bearish reversal, so it's going to head down. A W is a bullish reversal, so if you see a W, that means it's about to head back up. It goes down, down, and up again. So I would have got back in. Once I saw this down and it come up a little bit, if price was right here, this is what would have happened. Let's go to bear replay, par replay. For me personally, once I saw this, overall, I can say, yeah, this is what's supposed to happen. It's bounced up to 61.8. So I'm looking for price to get to 112, 500. Overall, I would look at that. I could have gotten in right here. Like I said, and for me, chances are I probably would have gotten in. Once I saw this bounce right here, I could have gotten in. Actually, I lied. I wouldn't have gotten in because of this M. Like once I saw this M formation and I see the sellers are pushing it down, it doesn't give me confidence to just enter right here and things are gonna go up because this M showed that, okay, this high did not take out this high. It's not like it came up a little bit higher and then came down. It didn't take out the high. So now we watch it, and we see what happens. Slowly, price does this, comes down, creates a W. This oil is creating a W. And now we're seeing right now, let's take this Fibonacci off. Now we create a Fibonacci the opposite way. And we see price bounce off the 50 and 61.8. So we think if price is truly in a downtrend, like truly, the next take profit would be this area right here, the 27 area. Boom. If it were in a true downtrend, because the M shows a downtrend, this lower high shows a downtrend. So if it's a true downtrend, we get in. But guess what happens? It wasn't a true downtrend. Look what it does. Boom. Creating dojis. And like I said, you pay attention to the candlesticks because look at price. Price is not, let me actually put that back. Price is not closing below. Like, yeah, it may wick below, like these wicks you see. Look at how these candles are closing. It's not trying to close below this key area. And that says a lot. That would be my first sign that says it's going back up. And then the next candle just pushes up. Boom. That shows, first of all, it breaks this trend line, which shows to be a counter trend line. It breaks the counter trend line. It creates a W. It creates basically a hammer, but kind of a doji, kind of a hammer, but a little bit of a doji on a key area. 110 is very, very strong. This is invalidated. This is not true. And now the overall, the original Fibonacci that we had the first time was right. It was just a very, very deep retracement. Boom. It's a 61.8. I need the play button. Boom. Let me watch it. We watch it. We watch it. Look at what price is doing. Boom. Wait, our take profit is up here. This key area right here. Also notice, if your take profit, like the 27 extension on Fibonacci, is above a key level, just place your take profit at the key level, because you don't want to get too caught up in, oh, it's 20 pips above. No, just place it at the key level, and same with this. So my take profit at the key level, it goes up, goes up. Boom. Nothing would have got me out. None of that would have phased me. Still wouldn't have phased me, because it still didn't break below this low or that low. So it's still in an uptrend. Boom, boom. Take profit secured, money secured, hit it secure. Boom, you're done. It's that simple. Let's bring it all the way back now. Boom. So now this is where price is right now, overall. I can delete all of this right now. And now price, look what price is doing now. This trend line, now price is breaking the trend line. Now we got to see if price wants, we know it's going to get to 110. We got to see if it breaks 110, because the price does break 110. We get 100% see price break this, retest, and then boom, just drop all the way to 108,800 at least, if not 109 flat. And then we'll cross that bridge about potentially lower when we get there, depending on the previous levels of low. It hasn't been this low in a while, but we'll see where it stops at way below there, based on later on, if it were to break 109. But right now, we're not looking at that. We're looking at this break a trend line, seeing if it can break this key level and go to 109. If it doesn't, if it just bounces off here again, then we know it can just obviously come back up and play within this range now and try to create another trend. But I hope that helps you guys a lot. You know, maybe it may be a little advanced and maybe confuse some of y'all, but just understand, like I said, the difference between a retracement and a reversal. Like, people can say this may be a retracement right here, because boom, so price should be getting to 184,200, but it's a little bit deeper. Price, you got to understand, look at the candlestick. This high right here created a new high. If price was really going all the way down to 184,200, this wouldn't have broke through here. It would have came a little bit shorter to create the highest high, lower high, another lower high, and continue down to 184. This was a high, lower high, then a higher high. It created a higher high, and right here is a higher low. So right now, price is showing that it wants to reverse. Like this, so this right here isn't just a retracement. This is a reversal, because this broke this high, it made a higher low, higher high. It broke above the 190 key area. Like, just look at all this stuff. It's above the moving average. Like, this is what price is doing right now. Understand that, and that's the difference between a retracement and a reversal. You have to pay very, very, very close attention to detail, because one wrong mistake and you can lose money in a trade, and then you're looking like, why did I just lose a few $100s? Why did I lose $50? Or why did I lose X amount of dollars, depending on my lot size? Like, I thought it was going down, like it went up, and I had a Fibonacci here. Why did it not go down? Because you didn't pay attention to the candlesticks. The candlesticks told you this created a new high, created a higher high and a higher low. The structure is broken, structure has changed, and now price is heading to the upside, and we're looking for price to break through this 192,500 area, which I don't know why I have it as an area, because it's not really it's just the midpoint, but I'm looking for price right now to head up here between this little range. This is lopsided as hell. 193,800. Now we're looking for price to boom, come within this area before coming back down and retracing and stuff like that. So hope this video helped you guys a lot. It's probably one of the favorite videos I made, because it's very, very helpful to understand the difference between a retracement and a reversal. You really, really have to understand that, because like I said, it can save you a lot of money and make you a whole bunch of money as well. So appreciate you guys, and I'll see you in the next one. All right, SWAGGY Academy students, I appreciate you guys. My last video in the current market conditions with the analysis of gold and GA and GEO, I talked about, counter trend lines and how to trade them. And then I just make a video and throw it in the advanced section. So that's what I'm doing right here. So let me go to a pair in U, for example. I kind of have a demo test little chart. This is like a little demo test chart because I don't trade in you, but I'm gonna start using it for like demo practices for you guys to give you guys examples. So find just a trend. So to find a counter trend line, you gotta find an actual trend. So this right here is an actual trend. You know what I mean? You can get this, boom, Ellipse tool, log it in. 1 bounce, 2 bounce, 3 bounce, and obviously that would be the 4th, but it didn't bounce, it broke through. So all right, so this is an actual trend line or actual trend. So to find a counter trend line, you got to find the actual trend. Once you find the actual trend, and the actual trend is an uptrend, actual trend, uptrend, then anything that seems like a downtrend will be considered a counter trend line. So what I could do is bar replay this to over here so you can imagine it just looking just like this, right? How it's like an actual trend line, boom, 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 right? Potentially get a bar across here as a resistance. Right, cool. So basically what you want to do, you can scale down to 4 hour, 2 hour, whatever the case may be. You can see little like downtrends in the midst of this. And basically these are called counter trend lines. So what that means is anytime you see a break of a counter trend line, you'd want to get in. So for example, this is all an uptrend on like a larger time frame, like a daily or 4 hour. You scale down just for entries, and you see, okay, let's place a little trend line right here, from here to here. Let's go to a mini one. Make this lighter right here. Just all the way light. Okay, cool. Right? Counter trend line from here to here. Once it breaks here, get in. It's that simple. Like once it, like counter trend lines help you because they go with the actual counter trend. Boom, bounce, 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 and then once it finally breaks, get in. That's your entry. Like literally, that is your entry. And wherever your take profit is, wherever it is, but that's your entry. Stop losses right below this low right here, and your obviously your take profit would be somewhere right up here, depending on where you would have it. But that's basically the purpose of our counter trend line. So we go back to the daily time frame. And we're at this point right here. See this line right here, the counter trend line breaks through, pushes up, has a little mini support, finds a little mini support right here. And it's the same process you would do every single time. So obviously in the midst of this, like I can look at it right now and say, okay, the reason I got in this trade as a buy is because it bounced off the trend line, the real trend line, 1. 2, cross above the moving average. 2, 3, there's a Fibonacci, clear as day here that obviously I can see because of my natural eye, but there's a Fibonacci from here to here, bounces at 8.6, boom. So Fibonacci. Number 4 is too many indecision candlesticks. Like it would not close below this level. Too many indecisive candlesticks, which show that it did not want to go to the downside. There's so many reasons to get in. And on top of that, the 5th reason is there was a counter trend line and it broke the counter trend line. So then you watch it go up, and then boom, stop. And then the next one. Boom, boom. Then it breaks this. Look at it closely. It broke this, and then it crossed above the moving average because it's below the moving average here a little bit. When above the moving average, guess what? It pushed up. You know what I mean? Like that's all it really is. Counter trend line right here. Boom. Bounce, 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 bounce. Like it's a downtrend, and then boom, push up. The minute it breaks the counter trend line, you get in. Don't trade the counter trend line because you never know, because it could easily do this 1, 2, and then shoot up. It doesn't have to come 3, 4, 5 times. But once it breaks, like best believe, get in. You know what I mean? Excuse me. So, and sometimes it's not as perfect. You know what I mean? With pairs like this, or moves like this, where there's not like a legit counter trend line. Like that could be considered a counter trend line, but it's too far out. But there's not one that's considered way down here. Then I would just wait, like I said, not for a break above, but just a bounce on the trend line. Once you get a bounce on the trend line and you see it's breaking or it's holding, and like you see how this candlestick closed and then boom, boom, a little morning star, and then push up. Then you can use it get in. Counter trend lines won't be seen on every single trend line, but when they are seen, just understand, just place a little mini trend line there, and then once it breaks, get in. Mini trend line here. Boom, boom, boom. 4 bounces, break above, get in. And it's still, I see a Fibonacci from here to here as well. Boom, 100 to 0, 61.8 bounce, all the way up there, boom. And same with this. Now it went up here, boom, started down here, right there, pushed up again. Like you constantly move, constantly adjust. Fibonacci, use all the tools that are given to you. Counter trend line, boom, right here. Broke above, get in. So go back to the daily time frame, you can look at it, it's like, this is the actual trend line. So obviously in this scenario, we're only looking for buys. It's counter trend. Every time it breaks the counter trend line, it goes up, comes all the way down. Like I said, this could be seen as a I don't know, harder version of a counter trend line in a sense, but breaks up. That's all the point and the purpose of a counter trend line is. It's really easy to use in your game. Just understand that not every period comes with a counter trend line. So just use it when you see it. Don't force it on there. So with this period, as far as like trend line application, obviously you look at it and look, it's breaking, retested the moving average and broke below. In this scenario, this is not a counter trend line. It's still retesting. This is an actual break. You see what I'm saying? You close below there to actually obviously sell it down, but get the close below. Now you can obviously get in and sell. Boom, goes down. Finds support right here, where at the third point of the trend line. So New Zealand overall should get way down here because this is where the trend line started. Remember in the trend line application and technical analysis, when price breaks a trend line, it more times than not touches every single point that the trend line touched. So 1, 2, 3. Chances are price will go 3, 2, 1. Chances are it can go 3 and then go up, but slowly, like usually by the end of a certain period of time, it will do that. Obviously, got to the third point already. Obviously, it's getting to the second point. Got to the second point. Found support right here at the second point. That's why I went back up a little bit. And now I'm pushing it up. It's pushing up. Eventually, it finds its way down to the first point. That's all that matters. And now found, obviously, resistance at the first point, which is amazing. So you guys get the point, you get the vision. That's basically all a counter trend line is. It's that simple in a sense. You just throw it on when you see it, because some pairs don't always have counter trend lines. Like you look at gold right here, and this is the actual trend right here, but where's the counter trend line? I could scale down, and it's not much. Like I wouldn't throw a counter trend line here. That'd kind of be forcing it. But you can, you can have one here. It doesn't look forced actually. Have a trend line here and then break above. Other than that, there's no other counter trend line. You can try to have this little fake thing right here and then watch it break up. But just be aware and mindful of counter trend lines because they can help and change your trading game dramatically. So hope that video helps, and I'll holler at you in the next one.